Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss what's been an eventful news week in the markets. Today, we're going to touch on four key themes, starting with inflation and its impact to the bond market versus stocks.
Yeah, I mean, it was only a week ago that we got that shock on the employment numbers and found out that January, or at least the recent employment data, was way stronger than people have been thinking. And then a little after that, we got really strong inflation numbers. So the markets have reacted pretty quickly. Bond yields especially, Jill, went up over 2% on the 10-year, which is a number we haven't seen for a number of years. The stock market in reality has coped pretty well, considering that the interest rates are starting to climb now.
Right. And let's talk about COVID here. The Omicron wave appears to be winding down with less damage than previous waves. Personally, whether or not you want to let your guard down is one thing, but it seems as if the markets are kind of moving away from that now.
Yeah, and I think the reason that everybody expected that the employment and the inflation numbers would be pretty weak was because Omicron was just such a massive spike in new cases. So many people caught it, which you can see in the data. But now that we're kind of coming out the other side, you can see the new cases are falling. Really, the number of hospitalizations, considering the number of cases, is way below expectations. So it wasn't as bad as people thought. I guess the one thing that did happen is you can see from around the other data that there's been a spike in people taking days off. That's affected some companies because a lot of workers have been missing in action. But in actual fact, that probably strains the employment situation rather than causing a lack of demand for workers.
About 3/4 of the companies in the S&P 500 have already reported fourth quarter earnings. What's your take on the performance?
Yeah, I mean, the performance has really been pretty good. It was expected to be pretty strong. We're seeing earnings coming in, growing about 30% year on year. So now we're through the end of last year. That basically accounts for the gains we had in the stock market last year. So, the earnings has grown as quickly as interest rates, or more quickly than interest rates, are sort of pulling back on valuations. What's interesting, I think, this quarter is more companies actually beat earnings than normal, but the companies that missed have been punished more in terms of how much their stock sold off. You saw a couple of companies with really big sell-offs straight after the market closed when they came out with their earnings. So there's definitely been some dispersion in terms of performance of companies after earnings. And we've also started to see the guidance tilting negative. So more companies, more than half of the companies, are suddenly saying to analysts, look, calm down. Last year was great, but next year might not be quite as great. So we're definitely seeing a little bit of tempering of expectations too.
Right. Well, which makes sense because we're going to get the results of how Q1 was impacted in Q2 when, there was labor shortages and people had to close their shops because they didn't have enough people working. So it makes sense that they're trying to temper expectations a bit. Finally, Phil, the continued geopolitical pressure out of Russia and Ukraine, how does a potential conflict impact local economies and the global markets?
Yeah, so Russia is a big petrochemical exporter, so gas and oil, massive supplier to the world. So you can already see some of the oil price impact. We've got oil coming back to near $100 a barrel. That's even affecting prices at the pump here. Gas is a big export from Russia into Europe, which obviously makes negotiating about what's going on in Ukraine hard for Europe as well, because they need the gas to keep their homes warm in the winter. There's been some efforts to try and get US gas onto boats over to Europe to fill the gap, but really it's not enough. The European market is so dependent on Russian gas. So it's a little bit of a problem, and it's definitely some risks in terms of the European economies and also European households just being able to keep their houses warm. And just from a market's perspective, lots of uncertainty right now. And so as soon as you think maybe the world could be tipped into a war, the market sells off. And when we think things are a little bit more certain, people feel better about the economy and what's going forward. But just another factor this week on the news cycle, really, isn't it?
Yeah, market's always going to be worried about something, isn't it, Phil? Thank you for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.